Hi everyone, it's Nick at finance.vote, and this is the first episode of a video series we're calling Decoding DeFi. And the purpose of this is to try and give people new to DeFi or people who are, not got all the time in the world to go digging into everything, a good overview of the core concepts and give you all the information that you need to be able to make informed decisions about how you want to engage with the DeFi space and the crypto space as a whole. So I'm going to dive right in and sort of go through where I want to go with this session. Really, this is a kind of super weird concept. It didn't really exist pre-June 2020 last year. And I think it's got a kind of unclear origins. It's a kind of meme. It's something that's emerged out of the sort of crypto culture, as it were. And it's got a kind of loose definition. There's nowhere where it's been properly defined as such, and I'm going to start to do a bit of that, I think. So I'm going to go through and provide some definitions to a kind of bunch of nested concepts or concepts related to it as a whole, and do so in a way that gives you the kind of story or the history of where it's come from, and try and land that definition at the end to say, okay, that's what this is. So the kind of story starts around December 2017. Now, this was just about the point where we were going to hit Bitcoin all-time highs. So everyone was completely euphoric. Things were going great. But in fact, everyone is about to get wrecked. Okay, so there was a 3-year bear market. Those of you around in that time will have known the kind of pain of where that went. But this is a good example of how the sort of next cycle's things or the next cycle's technologies emerge around in these periods. So that kind of funding wave that led to the big kind of ICO season moment we had in 2018 and late 2017 yielded some of the most important projects that exist today. And one of those is MakerDAO. So MakerDAO, I think, is one of the most important projects in DeFi. It was pretty much the central component of DeFi for a good couple of years. I think it started the ball rolling on DeFi, certainly. And if anything, it was a little bit too central to everything for a while, which concerned me. But actually, the space has diversified a lot, and I'll unpack where sort of MakerDAO sits within this story. But for me, the story starts there. And this chart from DeFi Pulse, it shows you exactly sort of what's happened in the last year. This is the total value locked. You'll sometimes hear the words TVL bandied around a lot in DeFi. And you can see that there was 2 or 3 years of flatline here where there was hardly any capital being locked up in MakerDAO. And then for a couple of years, it was starting to be used quite considerably. But MakerDAO dominance was like 80 or 90% of the whole DeFi space, if not higher. But something around April 2020, May 2020 caused and triggered this big event. And for me, what happened was the opportunities for yield, the opportunities for getting a return on your investment increased dramatically. And consequently, sort of DeFi found its place. And largely through some of the mechanisms we're going to talk about in this session. So let's start with the very core component of what we mean by yield. It's pretty straightforward. It's the idea that you get more money back than you put in. The money you get back extra on top of your initial investment, your principal, is yield. And so yield is actually a sort of measure. It's typically represented as a percentage of the initial principal. So, for example, 20% yield on $100, your outcome is going to be $120 at the end of the investment period, wherever it might be. So typically this is quoted in annual terms. So APR, annual percentage return, is kind of just a flat rate percentage yield. And APY is a percentage yield that incorporates compounding. And these phrases are often kind of interchangeably used throughout the DeFi space. They don't often mean what they mean in the traditional world, which is kind of typical of what happens in DeFi, mainly because the annualized returns of these things are so variable that it almost the terms don't really make any sense to be applied to them, but they're used nevertheless across the crypto space. In fact, you can see here in Compound, which is certainly one of the most sensible platforms in terms of controlling real APY or sort of genuine quotes on what the investment returns are going to be. And here you can see we've got the sort of both the supply side and the borrow side of the markets. So this is people supplying cryptocurrency to lend to other people, and people who are borrowing cryptocurrency from those suppliers. So the big sort of revelation about DeFi is that it's a kind of peer-to-peer lending and borrowing thing. So that's the kind of very basic instance of it. It's the ability to lock some crypto up and allow people to borrow that, and you obtain a return from those borrowers in doing so. So you can supply collateral and borrow collateral. And you can see that, I think this was taken yesterday. The yields on Compound are kind of fairly sensible. They're actually the returns generated by the platform using their sort of interest curves. I'll come back to Compound in a bit because they have a big role in this story. But another key concept is this idea of collateral. So collateral, again, it's a traditional finance word. It means basically securable value. If something can be used as collateral, it can be secured in such a way that it allows you to borrow or to get credit. So collateral is, it's something that is the crypto space is actually pretty good at, because you can provably lock assets up into a smart contract in such a way that they can be secured with cryptographic certainty. So crypto is great at being collateral, and I've got sort of here because it's incredibly volatile. So as we've seen in crypto this year, it can go up, thousands of percent. And in the previous years, we saw it can go down 90, 95%. So this typically wouldn't make great collateral in traditional terms, but this is overcoming the DeFi space by using over-collateralization. So if you want to loan some money, you will have to provide far more collateral than you are able to draw down value from a loan. So just as an example of where MakerDAO fits into this piece, I consider MakerDAO to be the kind of central bank of crypto. And it's like a central bank because it issues debt. It allows people to be able to draw down DAI, which is the stablecoin currency that is issued from MakerDAO. And it's essentially a digital dollar, but it's completely decentralized, or as close to decentralized as we've got at the moment in DeFi. And it's not pegged from an oracle. It's not reading a price somewhere. The mechanisms for how that keeps its peg, how it stays around $1, is through decentralized governance, essentially. And one of the decisions that the decentralized governance system makes in Maker is what the debt ceilings are on certain cryptocurrencies. So somewhere around 2019, MakerDAO opened up the ability to have not just Ether as collateral, which it was for most of its life, but to allow other assets in there. And one of the starting ones was Basic Attention Token, which you can sort of see here. Now, what's interesting about this image is that, which you can get from diestats.com, is what assets have been issued and what cryptocurrencies they're backed by. So decisions are made to allow DAI to be drawn down by certain collateral. Now, they don't let just any cryptocurrency in, especially emerging new assets. They tend to have to be very established and sort of with reasonable, strong guarantees that they're going to be around for the long term. And the way in which it determines how secure those assets are as collateral is by determining how much of those assets it will allow to be issued. So you can see there's a 3 million limit on Basic Attention Token here, and there's a 1.5 billion limit on Ethereum here. Now, you can also see the other thing that's interesting to point out here is the utilization rates. And that means is how much of that debt ceiling has been drawn down in DAI. And you can see here that the stability fees are essentially the cost of the borrower for drawing down that DAI. And through governance decisions, they will raise those values. They will raise the stability fee on certain assets to encourage people to put their DAI back in to essentially pay off their loans and take their collateral out, meaning that there's extra space, extra legroom for more DAI to be issued. So this is a really interesting example of decentralized governance, and I think at the moment it's one of the most strongest DeFi assets. So another key concept that I think is part of this story is this idea of leverage. So leverage is the idea of borrowing money to invest. So you can essentially lock some money up as collateral, borrow some money, and then reinvest it again. And this is called gaining leverage. So this increases your exposure to the market on the assets that you've got, but it also increases your risk. So the risk is the really important factor here. If you can take out loans on your crypto on Compound, for example, and take the crypto you've just loaned and loan it again, and therefore increasing your leverage in a compounded way. And that's kind of dangerous, which is why I've thrown in this phrase here, degen long, which is a crypto term for you're being a bit of a degenerate gambler by going way too long on your assets. Because if they go down, or up if you're shorting, then you can get liquidated, which means you lose the underlying collateral completely. So it should be used with extreme caution, and the crypto markets are so volatile, you don't really need leverage. The other sort of big component of the space that I think has been quite transformative, in fact, I think it's one of the most important components of DeFi, it's one of the precursors to this DeFi boom, it wouldn't be happening without it, is automated market makers, such as Uniswap, which you've almost certainly heard of. Now, I consider this to be kind of peak smart contracts. One of the most important smart contracts that's hit the Ethereum mainnet, and it allows people to trustlessly exchange assets. So we don't need to go to an exchange, a centralized trading venue, in order to swap currencies between each other. And that's a super important component of the crypto space, because otherwise the exchanges, the trading venues, get way too powerful. So just a quick overview on how these things work. Essentially, you have the balance in these contracts between two tokens, token sort of X and token Y in this case. And here you can see that there's a kind of a curve here on Uniswap, and if you put more tokens in, say, the X side, you'll start to be pushed down this curve this way. These AMMs, there's a very simple equation here, and that's this XY equals constant. They're sometimes called constant product market makers, so that's the product, and there's a constant here. It's very simple mathematics, but been extremely powerful. It's a very elegant solution. And there has been some interesting iterations on that. And this straight line you see here maps onto the curve for curve finance, and that allows low slippage swaps to occur. But that kind of only works when the assets are meant to be in parity. They're meant to have the same price in the first instance, like stablecoins, for example. So, for example, if you want to stop USDT for USDC, you can do so on curve with very minimal slippage, even at very high trading volumes. So another key bit of terminology here is this idea of liquidity. So you'll hear the word liquidity a lot in DeFi, and it's kind of part of this process of people using their cryptocurrency as collateral and getting returns on it. So providing liquidity means you're going to stake your crypto assets somewhere and receive some kind of incentive for that. Now, the term itself, liquidity, can be roughly summarized as the lack of friction on buying and selling an asset. So this is the kind of friction comes in with if you make a trade, if you buy an asset, it pushes the price upwards. So it kind of, by buying it, you're changing the price, and that's called slippage. So the less slippage there is, the higher or more liquid the market. So Bitcoin, for example, has just got to the point where it allows people like Elon Musk to buy like $1.5 billion of the asset without it kind of completely changing the price. Now, it obviously did have a price impact, but how much of that was kind of FOMO around Elon buying it and the actual purchase is hard to tell. But it just means that Bitcoin is an incredibly liquid asset now. So the liquidity is a really important component of this. And you can largely summarize is, can you convert your assets to cash quickly? And actually crypto, again, is really good at this. You can do this in single transaction, and you can start to sort of get into other cash-like assets like stablecoins. So a really important component of Uniswap, for example, is the ability to provide liquidity to those markets. So how far we move up and down those curves, and thus changing the price, is determined by the depth in that contract, how liquid it is, how much assets there is in there. So, for example, this is straight from the uniswap.org website. You can see that this person is called the deposit function, which means they're going to supply both sides of the market. So they're not buying one asset. They're putting both assets into the smart contract. So they're going to put at the ratio. So the ratio of this market is 10 to 1. So this user is going to put 10 tokens of A in and 1 token of B in, and obtain 4 LP shares in the process. So these LP shares are really important. They're a digital asset in themselves. So they're an ERC20 token that represents your share of that pool. Those assets are then added to the liquidity reserves, and there's a total pool value of 12 tokens in total. So this person holds that percentage of that pool. And here we've got a trader who's called the swap function, who's buying 1 of token B. So they're taking out a token, and the trader, the LPs here, earn a fee for that process. So by providing liquidity in these markets, you earn a share of the trading that occurs in that contract, which is typically what exchanges do. So it allows everyday people, anyone can do it, you can do it right now, become a market maker, to do fulfill a role that would typically happen inside a traditional centralized venue. So a huge part of the growth, I think, over the last sort of few years in crypto has been the adoption of stablecoins, sometimes called stables. And these are assets that aim to be stable. So we mentioned DAI earlier, which is the MakerDAO stablecoin, as a decentralized stablecoin. The majority of them are still centralized. They're still people holding money in a bank and then issue a digital asset that represents that money. And these are the cash of crypto. So there's some different ones are out there. There's an increasing number of decentralized stablecoins. Not many be able to keep their peg quite as effectively as MakerDAO. But you can see here we've also got this kind of like hockey stick adoption of stablecoins, and that's a good metric for how much real value is coming into DeFi, and the crypto space as a wider whole. And you can see USDT, which is a kind of controversial crypto asset. There was a lot of sort of indecision or uncertainty around whether Tether, who issue this cryptocurrency, are holding the cash. And that's kind of gone through the courts, and they're basically in the clear at the moment, which is good news for crypto. USDC is a much more regulated one, and they're US domiciled, I believe. Much more regulated, and there's much more sort of greater certainty out in them. They're gaining a lot of adoption in the near term, and there's newcomers like Binance's stablecoin BUSD, and there's DAI. And you can see the difference here is that it's collateralized by Ethereum, or it's collateralized by crypto assets, as opposed to being custodial. And over time, we will see this number drop down, very much in the way we saw maker dominance drop down. I think we'll see greater adoption of things like MakerDAO and decentralized stablecoins in the future. So I'm going to throw in a few sort of important products that are out there in the market that I think have been important milestones or important components of the DeFi space. And one of which I thought was sort of fantastic bit of technology is Curve Finance. And Curve are basically a AMM. They are very similar to Uniswap, except they allow sort of multiple assets to be basketed. So their sort of famous starting pool is this one that allows you to pool 3 kinds of stablecoins. And the reason why it wants you to do this is because it allows people to swap between these stablecoins in their liquidity pool. And by facilitating those decentralized trades between stablecoins, you earn a kind of base APY rate, and they will top that up with some of their own cryptocurrency of Curve tokens. And they can manage, and the governance in that system manages how many of these Curve tokens and the APYs and those kind of things. And you can start to see where DeFi starts to get a little bit crazy, where we get these chained up derivative assets in a basket, and we start to get into the derivative space, which is really quite interesting. So on derivatives, I think, again, these are one of the components that were required for the yield farming crazed kickoff. And they're essentially, in sort of traditional finance terms, they're any instrument that represents or derives its value of another asset or from another asset. And they can be assets. So a derivative can represent a basket of assets, for example, like an index. So derivatives are an important component of DeFi. In fact, LP tokens, which we were just talking about, are derivative assets in themselves. So the LP tokens represent shares of a liquidity pool. And when you dive deep into the documents of some of these DeFi products, you'll see that derivatives are used quite a lot. And in fact, those derivatives themselves can be used as collateral, which allows people to up their leverage, which is an important thing, or important part of the yield farming craze as well. So I think one of the sort of standout projects in the DeFi space is Synthetics, and they specialize in derivatives, or synths as they call them. So these are synthetic assets, and they allow you to generate, let's say, synthetic ether by collateralizing it with, and it used to be their token, SNX, but you can do it with other assets now. And I think one of the interesting things here is that you can mint assets that do different things related, that are informed by price oracles. So in this case, IF is inverse ether. So it's the opposite. It does the opposite price action to synthetic ether, or the main ether asset. And that means that you can, in a decentralized way, short the market. Now, this is going to be really important. When that next bear market comes, there's going to be projects with treasuries and large treasuries that essentially want to hedge themselves against the market by holding synthetic derivatives that give them the inverse exposure that they're looking for. So I think that's going to be a really important part of the space. Now, the derivative market in the traditional finance world is easily the biggest aspect of finance. There's around $1 quadrillion locked up in derivatives, many of which are so convoluted and sort of difficult to understand, or just ununderstandable because they're so wrapped up in sort of bureaucracy and sort of bad accounting, that we just don't know, where that value's gone, and that has raised itself as serious problems, in particular in the 2008 crash relating to sort of housing markets, or distressed housing debt. And I think DeFi has a huge part to play in that space by creating derivatives that are on-chain and therefore transparent. You can see provably what the underlying collateral is, that it is there, and you can see the route to unwinding these assets when it's required. Two other interesting assets that I think are worth pointing out in the derivative space. One is A tokens by Aave, and these essentially are like digital IOUs or sort of tickets that represent your position in any of these assets. So you can see we've got Ether, 0x, and a few other tokens here. If you stake Ether in Aave to lend your Ether, for example, you will receive A tokens in return. And the interesting thing about these tokens is that they vary in balance in your wallet to represent your position growing due to interest. And Compound does something similar. They have C tokens, and C tokens are the same thing for the Compound ecosystem. When you stake assets, you receive these in return. But the interesting thing about these is that you can then go and stake your A tokens or your C tokens in other DeFi projects and get yield on them as well. And this starts getting us into what this yield farming game is. It's people finding opportunities like that, staking their assets, getting derivatives in return, and finding places to stake those derivatives and sort of compound or increase their yield exposure to the market. So to start the sort of process of how did we get where we are now? So in that process from 2017, we just had a really long bear market. We started to show signs of recovery in early 2020, and then the pandemic happened. And there was a huge sell-off in the traditional market, and essentially, everything got wrecked. So Bitcoin crashed down to around $3,000. There was lots of assets that hit all-time lows in this cycle, at least. Ethereum went down to $100. In fact, the whole crypto market cap was just over $120 billion, which, if you look at it now, is somewhere around 1.6 trillion, which means that a huge amount of money has run into the space, and perhaps better said, to be created within the space as well, since just May 2020. So it's less than a year ago. But this is the sort of context. Things were pretty grim at this stage. At this point, people were saying utility tokens are gone forever, tokens are never coming back, DeFi is dead. And the reason why people were saying DeFi is dead is because there was a series of really high-profile hacks. The first movers in this space, such as BZX, they experienced some sort of really bad exploits. But one of the things that really came out of this that was important was that the protocol leaders, or the people who were managing these protocols, paused them. So there was people with management keys who could shut the protocol off. So there is no one who can shut Bitcoin off, for example. And this kind of exposed the fact that it might be the case that some of these decentralized protocols, these DeFi protocols, aren't that decentralized. And there's Charlie Lee here talking about, DeFi gives you the worst of both worlds, because you're getting the technical risk of putting your money in smart contracts, and actually also there's this centralization risk because there's people that manage these management keys. Now, this it was a negative moment. It was a grim moment for a lot of the space. MakerDAO in particular had a really bad time. But something changed pretty quickly after this. And it's starting to mature out of this space. And I've stuck this slide in here to show you that actually even DeFi that was out there, so Aave was around, there was products like Fulcrum and Dharma, Compound, but the yields were pretty low. So we're down into low single-digit yield here. So not only were the yields not that great, but also the projects themselves were showing their frailties. Now we've seen a lot of high-profile hacks since then, but the risk-return sort of ratios were high enough for people to take those risks. At this point, it didn't seem likely. But an important thing happened, and that was the emergence of governance tokens. So these are tokens that, and my sort of definition for governance tokens here, and we've got one in FVT, is they are tokens that represent power in decentralized systems. So a governance tokens represents power decentralizing. Now, power, if you like, is like the utility of this sort of cycle. There are many, many tokens out there. Many are saying they're governance tokens, but they aren't really, because they don't really actually confer power to the token holders. If they do, and they are designed properly, the token holders are genuinely governing the network, in the sense that they can change the smart contract architecture, they can change the monetary policy, they can genuinely steer the direction of the network into places that perhaps even the original creators hadn't even thought of themselves. And that for me is that's going to be the gold standard of governance tokens, is when token weighted voting happens in such a way that the network goes into directions that were never imagined. So I think they put the D in DeFi. They are a necessary component in the decentralization process, because it means you haven't got 3 to 6 to 7 members of people, on a multi-sig wallet, which they genuinely represent the power in that situation. So another sort of key primitive that came out after the governance token things, or actually around the same time, is this idea of liquidity mining. This has been around a little bit in the past. It had been used, there was something called transmining that exchanges used, which was to pay people in tokens for trading. This sort of process, I think the recent round of it was Synthetics that first introduced this, I think quite a long time before this DeFi boom, but around the same time in this wave, both Balancer and Compound started liquidity mining programs. And what that is the distribution of incentives to people who are providing liquidity. So if you're putting your money into these decentralized places, either for borrowing or lending or to facilitate decentralized trading markets, then you are providing liquidity and you get some kind of incentive in return, whether it's a slice of the trading fees or, as became the vogue here, and actually what really kicked things off, was some of these newly minted assets that have come into play. So I think you can pinpoint the point at which the hockey stick on the TVL started to happen, and it was when Compound started to issue their governance token to people who were providing liquidity in the markets. And people were, picking these tokens up for free, and then they hit really high values quite quickly. So people gained quite a bit of money with little to no principal in the beginning. Now that changes the risk profile in a way that hadn't been seen before, and I think was largely responsible for to where the whole DeFi space has gone since. So another token economics primitive that came around in this sort of May, June, July phase, it was around a little bit before that actually, was this idea of yield aggregation. So this is automated routing of assets to find the best yield. So there's the different protocols that exist, such as Aave and Compound, and they were offering variable yields. And the smart contracts such as iEarn Finance, which is Andre Cronje's project, which is now called Yearn Finance, would automatically route your money to the best yield over time. And this is kind of groundbreaking, and I think was really started to kind of move things on. And again, it's another component of the yield mining thing. And I think you can largely summarize this is it's staking plus strategy. And the strategy bit is where the kind of DeFi space is maturing into. So I think after Compound did its liquidity mining program, Yearn Finance did theirs, and theirs was really quite radically different in the sense that they minted an incredibly small amount of tokens, which was kind of unusual for the time, just 30,000 YFI. They've since actually minted more of them. And largely I did quite a bit of digging into their governance. It was a really sort of fascinating sort of research journey of figuring out the sort of story behind this. But essentially everything moved so quick that they never quite landed their distribution schedule. So it was never intended to finally be 30,000 tokens, but it gained a kind of meme quality that made them stick with it. But what was interesting is that the YFI was the whole launch was distributed to the liquidity miners. So people who were providing liquidity for the Yearn platform received these tokens as rewards. And some of these tokens, again, they obtained them essentially for free for the act of providing liquidity. And some of those YFI tokens hit all-time highs of $50,000 each. So that incredible gain from such a low starting point, from such a sort of high risk reward profile, really opened people's eyes to the potential of what was possible in DeFi. And there was 1 million fair launches after this, and most of them were pretty scammy. So the idea is that there's no pre-mine, there's no tokens held by the team, there's no tokens held by anyone else. In fact, the reason why the Yearn team minted more tokens was because they didn't have any, and consequently didn't have a treasury to build out the ecosystem. But it changed the symmetry of the trade towards the user, towards the retail participant, towards the sort of everyday person coming into the ecosystem a bit later on. I don't think we've seen a fair launch yet, personally, because I don't think this sort of asymmetry has been fully minimized. You had to be very lucky, and you had to be very on the inner circle to get some of those early YFI tokens. And in fact, there was quite a subsequent amount of these fair launches where essentially all the tokens just went to the people who were holding all the liquidity assets. So fast forwarding a little bit, we've had Compound, we've had the liquidity mining craze, and we're starting to get into this moment that we ended up calling DeFi summer, and this is where the money printing really started to happen. And not just that, there was just starting to be really wacky crypto economic games started to emerge, and the people who just sat at home in lockdown, who either just discovered crypto or were sort of deep into it already, were really sort of like getting very deep into this, and all sorts of crazy stuff started to happen. So, I mean, you can see here it was around July when we hit this exponential rise of new assets hitting the market. So this is the number of Uniswap pairs, so new tokens hitting the space. So if you look at CoinGecko or one of those, you can see there's like 3,000 to 5,000 assets. There are many, many more that never get indexed because there's just so many of them, and most of them are just scams or just vaporware. So, and there was a lot of that about. So this is when the ability to print money, the ability of tokens are back on the table now, and everyone just started to create their own projects, as happens in the decentralized space. And so I call these meme forks, and these are the ideas. A fork is just a cut and paste or slight modification of an existing code base, and a meme fork is just we've just copied this project and attached a meme to it. And unbelievably, these things did actually sort of really well at the time, but they didn't last very long. I thought this whole craze was actually sort of kick-started by Yam Finance, which was a bit of a mishmash of a few different DeFi projects. I think there was an algorithmic stablecoin in there. I think there was some liquidity routing, and something like $500 million was put into these contracts on the first day it was launched. But of course, this didn't go very well. It was unaudited code, and there was a bug in their governance system, which means they couldn't change. They were actually so decentralized they couldn't get their way out of it. And the project kind of died in the first instance. There's been subsequent iterations of it. Fortunately, people didn't lose all that money, but some people did. So all of those things that I've mentioned up to this point are part of this yield farming phenomena. Like, they're different components of this idea or this kind of process. So I want to kind of propose that and you'll often see yield farming conflated with liquidity mining. So farming being I'm putting some tokens in this contract and I'm getting some free tokens in return. I think it's a bit deeper than that. And yield farming is actually a practice. It's a process of looking or actively looking for the best yield. So it's a strategy game. And there's also this additional layer to it where, as part of these strategies, you would take these derivative assets that you're getting in return and staking them subsequently into a kind of chain of contracts. And I saw some of these go 6 or 7 contracts deep, and all with really volatile sub-assets as well. People are really fortunate the market didn't crash around this time, because there would have been a huge amount of liquidations. But I think this is what we can conceptualize yield farming as. It's the strategic seeking of yield. And I think this kind of meme summarizes it quite nicely, as memes often do. So we've got our Chad yield farmer here, who he swaps and borrows 13 tokens in a single transaction. He's earning governance tokens for his work. So he's got these compounded positions. He's getting his liquidity mining incentives. He's manipulating the price on dexes, and he's all about the APR. He's all about getting yield. So this kind of conceptualizes what this idea is. Things got a bit crazy at this point. So September is when it started to unwind a little bit and start to get a bit silly. There was so many YFI forks that no one could keep up, and the market sort of got fairly diluted. So, one of our citizens in our citizens group for finance.vote suggested I sort of overview what I mean by Ponzinomics, which is a term that again emerged out of the DeFi space, and it's this idea that you can engineer token distributions and emission schedules in a way that makes number go up. So they're almost guaranteed, if you know what you're doing, to make money. Now, obviously, that doesn't last for very long, but the creation of these new digital assets, that if enough buyers come into the market, was allowing people to exit money on almost a zero cost of entry. So again, these things don't last very long, but I tend to consider them what I call public asymmetric games. So an asymmetric game would mean I have a greater advantage than you purely because I know more about the game than you. So I have asymmetric information. So I have asymmetric gain over you. And typically I will be able to realize that as a financial gain over you. And this is what the SEC do, is to try and stop people from doing this in the traditional markets. It's illegal. If you're manipulating the market on insider information, it's unfair. So it's both unethical and illegal. But there's something interesting about these games, and particularly I'm thinking of these algorithmic rebasing stablecoins as a good example of this. They were super complicated. You really needed to understand the contracts in order to get them. But there was a small group of people who could understand this thing and win on these things. These are self-titled degens, or some of them are at least. The smart ones knew what they were doing. And essentially, these, although they don't last very long, there were people who made money out of this. And I think the peak of this was, or a real trigger point for this kind of moment, was the product-based money, which I recommend you look at the website. It's pretty crazy. I wouldn't buy it, but it's pretty mad. So in this phase, there was a lot of this about. And you'll hear this phrase, wrecked. What does it mean? It's become part of our vocabulary. So I thought might unpack what it means here. And again, loose definition, but I'm going to sort of say that it's the process of, if yield is getting more money back from what you put in, getting wrecked is getting less money back than what you put in. And there's obviously varying degrees of that. And the worst kind is when you essentially lose everything that you've put in because of some underlying technical failure or an exploit. So obviously these things called flash loans exist, which allow people to manipulate these DeFi systems in a way that they can get away or yank the money out of the system. I think the useful term to know, you don't want to be it. And the way to do that is essentially to stay away from things you don't understand. There's another important thing here that is talked about a lot. Now, I think it's probably worthy of an entire video to itself. There's some fairly cutting edge research on this. Still, again, it's one of these concepts that's still loose in definition. It was called impermanent loss for quite a while. But it can be permanent. It doesn't quite work that way. But the original person who coined this term tried to change it to divergent loss, but it's kind of not really taken on as much. And it's the idea that when you provide liquidity in this kind of equal ratio in a Uniswap market, if this asset sort of gains much more than this one, the divergence from the point at which you provided liquidity results in loss and due to arbitrage activity. So the AMMs get arbitrage. That's how they stay in whack with decentralized markets. And the value essentially gets leached out of those contracts. And as an LP, you essentially lose money. Relatively to holding, you'll still be holding a percentage of these assets that you've got in there. You still hold the same shares that you did before. But you would have been better holding. And that's the idea of divergent loss. So it's not a great idea to LP into things that you expect one of the tokens and not the other to radically gain in price. As a corollary to that, unless there's good incentives to offset it. So in summary, yield is central to the DeFi space. It's a kind of important component. It is the central component to everything. And I think the number of opportunities that arose, starting with the issuance of governance tokens and liquidity mining programs, so these token economics primitives that I like to call them, is these new things that have come into the market created more opportunity. And with more opportunity, there came more money. And it created this kind of feedback loop that's kicked off the sort of DeFi boom. So new innovation, new ways of handling digital assets, but also the adoption that those new incentives brought is really what drives the crypto market forward. It's all about adoption. It's all about people understanding these things and starting to get involved and exploring the space themselves. And I think yield farming or an effective yield farmer is someone that keeps a very close eye on the opportunities or has sort of alpha, as they call it, and executes on that. And you'll find that a lot of people don't really share their alpha very often because the more people that join, the less yield they get, unless the systems are designed in such a way that mitigates against that. And as part of that, I recommend you check out yield.vote, which we'll be releasing in the next few weeks, which it's starting to overcome some of these problems. So we're connecting governance to liquidity mining. And I think where we're going next is that we're going to start to see the emergence of much more nuanced or advanced governance systems. I think we'll see the major adoption of prediction markets. So check out markets.vote, so our prediction market, to get an insight on what they might look like. And I think with the whole boom of the NFT space, I think we can get stuck on NFTs being the thing, but it's actually creativity that's coming to the space that's the important thing, and the artists and creatives that are entering the space is really what's going to help us create the value in the next new round. And I also think we'll start to see much more sensible token economics. So we're going to move out of this Ponzi-nomics era. We're going to move away from memes, and we're going to start to see real token engineering that builds sustainable growth. And I think that means transparent vesting. It means emission schedules that people can openly view and prove that they are what they are. And I think we'll move into a much more mature and interesting space when people eventually start to understand that token economics is probably the most important thing as you get away from the protocol level. So I'm going to leave that with you there. Let your minds drift away to what might be next as well. Come and join us in our Telegram. Subscribe to our channel and keep up with these videos. We'll be doing at least a couple a month. Okay, bye everyone.